Thank you, Jonathan. Thank you, Marty, for including our paper in the program. I hope you have enough stamina to withstand another hour or so of more paper discussion. This is joint work with Moritz, who is here to make sure that I don't screw up, and Alan, who really wanted to be here, but because of a family emergency, he is unable to attend. And because I have at least a partial affiliation with the Fed, you can see there in really tiny font that I have to disclaim that these are my views or the views that Moritz, Alan, and I share, but not necessarily those of the Federal Reserve System. So the way I think about this paper is a little bit like an episode of Law and Order, except you're just going to get the first half. So in the first half of the episodes of Law and Order, you get the cops collecting evidence. And then the cops turn the evidence to people like you, and you formulate a theory of the crime based on the evidence that we provide you. And then off you go and you try your case, and then that's how it works. And so one of the reasons why we wrote this paper, in a sense, is because we came across a really nasty type of criminal, which was the Great Recession. So, serial killers are easy because you have data very frequently, right? And so that's really easy to prosecute. You get a lot of data of similar events. You say, yeah, I can build a case to prosecute a serial killer. But every now and then, you have this sort of thing that it's hard to put your finger on. And it happens so rarely. And so unless you really dig down, you really can't collect the data to make the case. And so that's really what got us started. Okay, so this is one of those papers that's really great to present because it's just the data. There's no analysis. There's a lot of speculation on my part, and that's for you to decide whether it merits working a little harder in terms of writing models. But I hope that you'll find what I'm about to present today somewhat intriguing. So here's what I'm going to basically come down to. I'm going to show you a bunch of data on the long run, and it's going to basically tell you that, yes, there's a lot more credit sloshing about the economy now than there ever was in any point in history, at least in the last 150 years, but that's possibly not a wrong statement. That sloshing around of credit and that turn of events that we see in the long span of 150 years, we believe has important consequences for how we think about the business cycle. And that's the part where I hope you'll find the evidence that I'm about to present somewhat stimulating. In particular, I think that one of the things that's going to be of most interest is that in the post-World War II era, a lot of things change. And they change right around the time where we start thinking about the Great Moderation. So perhaps you'll think somewhat differently about the Great Moderation. You'll think that perhaps the way you thought about it all these years maybe needs revisiting. Maybe not. We'll see. So if I were to summarize the takeaway from this paper, I was just talking with Moritz, and I think Hyman Minsky has the perfect takeaway, and that is stability is destabilizing. So that's going to be the takeaway of the paper. This run-up in credit that we've seen in history seems to provide stability to economies. Volatility goes down, even though growth goes down a little bit. But it's also the case that it creates this higher likelihood of really negative events. And so that's the sense in which stability is destabilizing is probably the right takeaway. I'm going to discuss a little bit what are the consequences of this big run-up in credit for, let's call it the domestic economy, but I'm also going to talk a little bit about international moments as well. And the theme there is that despite the fact that you think that credit would allow you to diversify, it would allow you to smooth consumption more easily, it would allow you to do all those things that we kind of teach in our introductory macro courses, the evidence seems to go a little bit against that. It seems to be that consumption correlates more highly with output. It seems to be that there's less international diversification. It seems to be that there's a higher equity premium. And those things, a little bit, I think are hard to puzzle together. And so I hope that that's the case that I bring for you to theorize about and formulate the case for the judge. Okay, so the big contribution of the paper, and I think it's not just for this paper, but it has been some effort that has taken a number of years, is without a doubt the collection of data, the collection of evidence in our episode of Law and Order. And this has involved an army of RAs and visits to different countries and calls to colleagues in many of these countries and specialists and almanacs and dusty books that had to be opened for the first time in many, many years, and putting all that data and making sure that it was all consistent and so on. And so I think that, without a doubt, is the value added of this paper. Now, so to summarize, what are the contents of this big data effort? We now have data on 17 advanced economies. It's in annual frequency since 1870. We have 25 real and nominal variables. The ones that are really new, because not all of them are new, or they're not ones that we put together, but these in particular certainly are, is measures of bank credit to the non-financial sector. We have disaggregated that a little bit, so we know how much of that was to mortgages and how much of that was to non-mortgages, which mostly is unsecured credit, is the type of credit you'd think of in the typical model of a bank. That function of intermediation that banks are assigned in typical textbooks are usually about unsecured credit, not about mortgages. We also have some data disaggregated by households and firms, and you'll see that there's a very strong connection. Most of the credit to households is in the form of mortgages. Okay, so the same share is going to appear in either mortgages, non-mortgages, or households versus firms. Data on house prices, so we've extended a lot of data series that existed in some form or another, but we've expanded it to more countries, and we've expanded it further in time. And we also have data on equity prices. Now, it's true that a lot of the data that we have in this particular data set existed in one form or another in other sources. What we've done is basically put it under a common umbrella so that you can more easily access it. There is a very detailed data appendix that we hope to publish online so that you can know where every point of every single variable was collected and what was the source and how was it put together. And that will appear along with, I hope, the data at some point in the not too distant future in an NBER website. Okay, right. So let's go entry by entry on this table. This is just to show you that there's a lot of texture in the data set that we put together. So it's not meant for you to start reading the lines and the entries, but that's just to give you a sense of the monumental task that it took to put together this data set. And these are sort of the samples available for each variable, and there's not even all the variables in the data set in this one table, so you can imagine how it went. And you have all the countries, and it's fun. It's good stuff. Okay, so we figured out that the climate scientists had a good term when they defined the financial hockey stick. Sorry, the hockey stick, the climate hockey stick. And so we thought, well, let's borrow from people who are very clever, and we are going to sell you, I hope, on the idea that there is something like a financial hockey stick. Okay, so this is going to be the first part of the talk about the long-run properties of what has happened in the world in the last few years. Okay, so first off, here's a bird's eye view of the main story. This is what I'm going to call the great leveraging. And on the graph, you have three pieces of information. The main piece of information is the red line, which is a line that depicts the ratio of total loans to the non-financial sector as a ratio to GDP. And that's compared with a dashed blue line, which is broad money, also expressed as a ratio to the GDP. And comparing those two, the one takeaway from that graph already is that if you look at around the 1970s, that ratio of total loans to GDP really takes off. And it disconnects from broad money in a very significant way. There's another piece of information there, which is these green bars. These green bars tell you, year in, year out, how many countries in our sample were in financial crises. And so what you see starting in 1870 is basically this looks like any data series. And then after World War II and up to the fall of Bretton Woods, absolutely nothing. So if you were to do a statistical test in which you use the history up to World War II, and you were to ask yourself, given the instance of crisis in any given period, what is the likelihood that I would string together 30 years of basically no crisis? Basically, that probability is as close to zero as you'll ever see. There was something different in that period. And I don't think there is a good answer that I found out available in the literature. So I think it is an open question. And I think it has to do probably more with how the regulatory architecture of the Great Depression was brought into functioning. There was a fair amount of financial repression during this year. But what broke that string of success, that is still an open question that probably bears a little bit more study. Now, if you look at some sort of explanation as to where this great leveraging comes from, it basically has to be found in what has happened to mortgages. Okay. It's far less related to what has happened in the corporate world, although it is true that leverage defined the way I just did in terms of as a ratio to GDP. It's more a story about households and mortgages, and it's less a story of firms borrowing. And so I think in the conclusion I say it's less about Bernanke, Girdler, and Gilchrist. And except for Bernanke, I think the other two are here, so they're going to hate me. And it's more about Jacobello. Okay, so to me, that model is going to be perhaps a better story for what we're seeing here in the data than the financial accelerator story. Parenthetically, if you want to know what the share of non-mortgage to mortgage lending is, about 1/3 to non-mortgages, 2/3 to mortgages. And it's about the same share if you look at corporates and households. Now, what has this increase in mortgages translated into? You could think of it as, in essence, expansions in the intensive margin or the extensive margin. And I'm going to give you evidence for both. So here's another hockey stick. Apparently, we're hockey fans now. House prices here expressed in real terms using CPI data. Okay, so you have a fair amount of stability, almost to the 1970s, 1980s, and then again, house prices in real terms take off. Okay. Now, it's also true that more households own homes than ever before. Moritz is fond of reading Das Kapital before he goes to bed. And so he tells me that even Karl Marx in the 1800s, late 1800s, has a line in there that says that home ownership in the UK back in the day was in the single digits, okay, in terms of percent. So here what you have is a table of owner-occupied share of housing. And you can see that for most countries in our sample, there's definitely a very decided increase, and there's a fair amount of heterogeneity. Not every country adopted the types of policies that, for example, were prevalent in the United States after the Great Depression, and that were continued after World War II with the GI Bill. Other countries have a very different treatment of taxation of mortgage interest and other reasons why you have quite a bit of dispersion in home ownership rates. But by and large, if you look at the aggregate, home ownership rates have never been higher in advanced economies. Now, I've talked about quote-unquote leverage by talking about credit as a ratio to income. And you may say, well, that's not the definition that we typically use in finance. We typically look as a ratio to asset price asset price times asset quantity. Well, that's true, but if you thought that way in the eve of the financial crisis, you would have thought that leverage in housing markets wasn't that bad at all, or in fact was declining, when in reality, if you were looking at the amount of credit relative to income, which must be related in some fundamental way, given that you have to pay out of income your monthly mortgage payment, then to us, that's the more meaningful quantity. Now, it's a lot harder to get data on wealth, but here's an example. And what you should take away from this picture is no matter how you measure leverage, whether you like our measure based on a ratio to GDP, or whether you look in terms of wealth, it is the case that over the span of the years plotted here, which is basically post-World War II, that ratio has gone up as well. Okay, so that's the hockey stick. That's kind of the break in the data. That's the thing that we have to contend with. And so how does that affect the business cycle? Very quickly, since I have a lot to go through in the limited time that I have. Here's a picture. On the top line, you have the duration in years of typical expansions and recessions broken down by era. You have the rate of growth per annum for GDP, and you have the same thing for credit. And the basic thing that you see between one era and the next, pre-World War II and post-World War II, is the sort of strong connection that there is between well, first off, the lengthening of expansions post-World War II, even though we grow at a slower rate. And then the much tighter connection that there is between the credit cycle and the business cycle. So if you look at the bottom of that table, you have a concordance index. And that basically tells you how often both credit and GDP are in the same stage of the cycle. And that has basically tied much more closely post-World War II than it did in World War I. Now, this table is one that tries to get at the question of, is credit always bad? And it's not a welfare calculation by any stretch of the imagination, but it is trying to give you a sense. And here's the experiment. It says, suppose that I bend every recession into whether its credit grew above mean or below mean. And I'm going to do two experiments. Experiment one. I'm going to see if you're growing above mean in a given expansion, what happens in the following recession, and then calculate the difference in gained GDP versus lost GDP. And then I'm going to do the opposite. I'm going to say, suppose that you delever a lot in this recession, what happens in the following expansion? And you have a very interesting asymmetry. So if you have credit growing very quickly in this expansion, that expansion lasts a lot longer, and so you accumulate a lot more growth. And that is true. You have a worse recession, but on net, you end up gaining quite a lot, about 0.75% per year. If you do the opposite, which is delever a lot in the recession, then your following expansion seems to be a lot quicker and a lot longer lasting. Okay, so there you have the numbers. So 0.75%, 1.1%. Those are the numbers that you can bandy about. So at least there's a partial answer to that question that we've had over the years. Okay, so business cycle moments. Let me show you the pictures, but basically let's keep these facts in mind. Lower volatility, but higher skew. More rare disasters, okay? Both of these figures show you what has happened to GDP growth in what is called a bin scatter. A bin scatter basically is a scatter plot in which you bin by the value, in this case, of the credit to GDP. And what you can see in the first picture is perhaps a story that says it's bad to have too little finance. As you move up, perhaps that improves, and then as you have too much finance, maybe things get worse, but I don't want to make a story out of that picture. It's suggestive. The bottom row shows you what happened in post-World War II. And there what you see clearly is more finance, lower rates of growth. But it's not only that. You also have lower volatility. You can see it in GDP, consumption, and investment, but you also have more negative skew. The more finance measured by credit to GDP, the more negative the skew. And in the bottom row, what you see is more extreme is the bottom 10th percentile, more extreme values. And this is just post-World War II. You also see a higher correlation of real economic activity with credit. And you also see something that is, at least to me, a little bit curious, which is what I was talking about, the ability to smooth consumption. There's a higher degree of correlation between GDP and consumption at higher levels of credit to GDP, and that seems a little odd. Okay, I won't go through the international moments since I basically pissed all my time talking about law and order. But the basic takeaway is there's also less diversification at the international level. There's more correlation of GDP across economies, and that seems to go on with higher levels of credit to GDP. Okay, so here are some of the things that I think are important, how to fit the data into what we know about macro models. And I was talking before about financial accelerator versus focusing on housing. It reinforces a lot of the work that Atif and Amir have done. It links very well with some of the work that you see there by Egerton and Krugman, Kornick and Simset. It links a lot with some of the work that Pierre-Olivier has done with Emmanuel, which I saw here. Anyway, there's a lot here that I think you can sink your teeth in, and it's, I think, a good first step for us to start rethinking how we think about macro models.